Bitcoin dropped 65% in 2022, from a high of $69,000 to a low of under $16,000. Most retail investors who held Bitcoin through that period sold somewhere in the middle. Not because the thesis changed, not because the TAM argument broke down, not because anything fundamental shifted about what Bitcoin is or what it's competing for. They sold because they needed cash. They had no other source of income to cover their expenses. The portfolio was the only option, and that is the most expensive mistake in long-term investing. Not picking the wrong asset, selling the right asset at the wrong time. This video is about the mechanism that prevents that mistake by design. Not discipline, not willpower, not a better spreadsheet. A structural circuit breaker built into the portfolio itself. Most investors think they sell during drawdowns because they lose conviction. That is rarely true. Research on investor behavior consistently shows that retail investors do not sell because they stop believing in the asset. They sell because external financial pressure forces them to liquidate. Rent, bills, an unexpected expense, a period of reduced income. When your portfolio is your only source of liquidity, every financial stress event becomes an argument for selling. And the most financially stressful moments, recessions, job disruptions, market volatility, happen to occur at exactly the same time the portfolio is down. The correlation is not a coincidence. Economic stress and market stress move together. They are caused by the same forces. So the investor who holds growth assets with no income floor is structurally guaranteed to face maximum selling pressure at minimum portfolio value. The system is designed to break them. The circuit breaker is the mechanism that interrupts that chain of causation before it reaches the sell button. I have seen this exact failure mode play out in the gym, just with different stakes. A lifter builds a training protocol around one variable, maximum intensity. Every session to failure, no deload weeks, no recovery protocols, no attention to sleep or nutrition as active inputs to the system. For the first 6 months, results are extraordinary. Progressive overload is working. Numbers are going up every session. Then an injury happens. A joint, a muscle, a nervous system that refuses to recover, and the lifter is forced out of the gym for 3 months. During those 3 months, every adaptation built over 6 months begins reversing. The gains that required hundreds of sessions to accumulate disappear in weeks. When the lifter returns, they are starting from a point materially behind where they would have been if they had incorporated recovery from the beginning. The injury was not a random event. It was the predictable outcome of a system with no circuit breaker. Maximum stimulus with no protection mechanism is not a sustainable strategy. It is a countdown. The portfolio equivalent, concentrated growth exposure with no income floor, is maximum upside with no protection mechanism. The drawdown is not random. The liquidation pressure is predictable. The only question is when, not whether. Let me walk through exactly what happens in 2 scenarios when Bitcoin draws down 60%. Scenario 1, growth engine only, no income floor, Bitcoin drops 60%, portfolio value falls significantly. Monthly expenses continue. They do not care what Bitcoin is doing. The investor has 3 options. Draw on cash reserves if any exist, take on debt, or sell Bitcoin at depressed prices to cover expenses. If cash reserves are depleted, and in a sustained bear market, that can happen within 6 to 12 months, the investor is selling. At the bottom, locking in losses that cannot recover because the shares sold at the bottom are no longer in the portfolio when the recovery happens. The psychological damage is compounding the financial damage. Every month of declining prices, increasing financial pressure, and forced selling reinforces the narrative that the thesis was wrong. By month 12, many investors have exited entirely, just in time to miss the recovery. Scenario 2, growth engine plus income floor, Bitcoin drops 60%. Portfolio value falls significantly. Monthly expenses continue, but the income floor keeps running. Covered call ETF distributions land every month, automatically. DRIP reinvests them into more shares at depressed prices, which will compound at a higher rate when prices recover. The investor's monthly expenses are covered without touching the growth engine. The financial pressure that would have forced a sell is removed. The psychological pressure diminishes because the portfolio is still generating income. The investor holds through the bottom, participates in the full recovery. That is the circuit breaker. Same asset, same drawdown, completely different outcome, based entirely on whether the income floor was running. I want to make a claim that sounds counterintuitive, and then explain why it is actually the most important insight in this entire series. The income floor's most valuable function is not the income. The income matters. Monthly distributions covering expenses without selling shares, that is a real and significant benefit. But the income is quantifiable. You can put a number on it. What you cannot easily quantify is the behavioral protection. The value of holding Bitcoin through a 60% drawdown, of not selling at the bottom, is the entire upside of the subsequent recovery. That recovery is what makes Bitcoin a generational wealth-building asset. Investors who sold at the bottom captured zero of it. The income floor did not generate that upside. The growth engine did. But the income floor created the conditions under which the investor was able to hold through the environment that produced it. The circuit breaker's value is the decision it prevented. That is not something that appears on a distribution statement. But it is real, and it compounds. The training protocol has the same structure, and the parallel is exact. The recovery protocol does not build muscle. Deload weeks do not add strength. Sleep does not increase your bench press. But without the recovery protocol, the injury happens. And the injury forces time out of the gym. And the time out of the gym reverses every adaptation the training sessions built. The recovery protocol's value is not what it produces directly, it is what it prevents. The injury that would have broken the compounding is the thing recovery is protecting against. This is structurally identical to the income floor in the portfolio. The income floor does not generate the growth. The growth engine does that. The income floor prevents the forced liquidation that would interrupt the growth engine's compounding at exactly the moment when the compounding is most vulnerable. Both systems, the training protocol and the two-engine portfolio, are designed around the same insight. The second engine does not do the same job as the first. It does the job that makes the first engine survivable. Here is the framework. The growth engine produces asymmetric returns from concentrated positions in the largest available TAMs. It requires tolerating volatility. It requires holding through drawdowns that feel catastrophic in the moment and look obvious in hindsight. Most investors cannot hold through those drawdowns, not because they lack conviction, but because they lack income. The income floor solves that problem structurally. Monthly distributions, automatically reinvested during drawdowns, covering expenses without touching the growth engine, remove the financial pressure that forces the sell. The circuit breaker is not a product. It is an architecture. It is the decision to build both engines before you need the second one, because by the time you need it, it will be too late to build it. This is not financial advice. It is a documented system built from real capital and real hard lessons. Do your own research. Understand what you own before you buy it. The next video covers a risk that most income floor investors are not watching: premium compression in low volatility environments, what it looks like, and how to monitor for it before it becomes a problem. Subscribe if that is the content you came here for. Drop a comment below. Did you hold through the last Bitcoin drawdown, or did you sell? I read everyone. I'm built and bankrolled. Let's get to work.